Hey guys, Max here, and yesterday was just awful for stocks, as I'm sure you all saw. Markets took a major hit, and people who still have their money in the markets right now saw lots of blood as well. Right now, the Nasdaq is actually looking very likely to post its worst month since 2008. It really is that bad. As you can see then, it is red everywhere. Nvidia is down 5.6%. Amazon was down 4.6%. Apple and Microsoft were down 3.7% each. Google and Facebook were down over 3% as well. Tesla got absolutely hammered supposedly on this Elon Twitter news, and it lost 12% in one single day. Tech obviously did quite poorly then, but nothing else really did well though. Financials, they were down 2 to 3% and saw declines all over. Industrials and materials had the same story. Healthcare was down, consumer staples were down, real estate was down. The only sector which didn't do awfully was energy, but even that was pretty stagnant, and the only reason energy stocks didn't fall by and large was because oil and gas prices went up. Now, it isn't just America that's crashing though, the rest of the world fell off the cliff as well. Canada, the UK, the rest of the EU, China and Japan, everything was bad yesterday, everything fell as you can see. Well, the S&P 500 fell by 2.8% and the Nasdaq 100 fell by 3.95%. Tech did worse, so that was expected. Now, the Russell 2000, though, the lower 2,000 out of the 3,000 largest publicly traded companies in the US, the companies that actually make up the country, and in my opinion, the best stock market indicator of the US economy, it was down at 3.3%, worse than the S&P. The Stoxx 600 was down 1%, China's Shanghai index was down 1.4%. As I said, there was just red everywhere. Now, why was it so bad? Well, that's actually a little bit hard to say. Before markets closed, it was mostly just based on the bad sentiment that we've seen recently, the usual stuff. Fears of COVID in China and the disruption of supply chains, fears of the Federal Reserve continuing to tighten their monetary policy and even accelerate that tightening next month. Fears of a recession are not going away either. But since market close, markets got worse after hours as we had some bad earnings reports from major companies, and we will go into detail into each of those in a moment. It seems though that most investors are just scared in general. Fear of recession in particular is getting particularly high right now. A portfolio strategist at a firm in New York came out and said that there's no question that economic growth is in trouble and that the runway for central banks to manage a soft landing is getting smaller as wages and inflation move higher. The big question for asset allocation is not whether inflation will be high. That's a given. Instead, it's whether growth can keep up. The fear here is basically that with some corporate earnings looking at less than ideal, that growth can't keep up with inflation, meaning we're probably heading for some kind of stagflation, which is a terrifying idea for most investors. That is, in my opinion at least, simply why stocks are doing poorly. There is just loads of fear out there right now. We're pretty much at the trial that we saw earlier in the year, just over a month ago. One more red day and suddenly we will be in new lows for this bear market. The US dollar, though, is still strong and getting far stronger. The euro is sitting at $1.06 right now, getting very close to parity. The pound is sitting at $1.25 right now, falling a lot too. The US dollar is expected to be strong, in my opinion, right up until the crash seriously accelerates, and then I expect this to reverse as the problems with the US economy come to the surface. In the short term, though, there is still probably more strength for the dollar in that terms. Now, bond yields continue to fall actually, with prices rising. This seems to be because investors are seeking safer assets, so they're fleeing their risk on assets and moving into things like bonds. US 10-year Treasury yields fell by 7 basis points yesterday. They're now sitting at 2.75%, still very high, let's not forget. German 10-year yields fell 2 basis points and the British 10-year yields fell by 4. Now, oil prices actually rose. They didn't stay below $100 a barrel as I said would happen just a few days ago. It was just a little bit obvious, let's be honest. WTI crude oil rose up 4% yesterday. It's now sitting at $102 a barrel. Brent crude oil rose too, and it's now sitting at $105 a barrel. Gold is holding steady at the $1,900 an ounce mark. Again, I'd like to see it fall slightly, but with inflation getting worse still, risk on assets tanking across the board, that does seem a little bit unlikely right now. Finally then, for the markets, what happened in the crypto markets? What's going on there? Well, it fell for the most part. Bitcoin and Ethereum were both down by 4% each yesterday. Bitcoin's now sitting at $39,000 and Ethereum sitting at $2,900. The altcoin market did way worse though. It's down between 3 and 10% for the most part. Dogecoin obviously had a good day the other day on that Elon news that he's buying Twitter, but now it's seen an equally bad day as people realize they overreacted to the positive news and the spin that was put on it. Dogecoin fell 13% yesterday alone, which was a major dip. Now, we are going to quickly talk about some companies' earnings, their reports, and the performances, just before we go on to finish on some fears growing about the war in Ukraine. Now, Visa had their earnings and they did well, and they rose almost 6% in after-hours trading. Despite Visa's exit from the Russian market, there were lots of fears about the impact of that, but Visa came through and did well anyway. The only real bad news from Visa's reports were that their costs rose by quite a lot more than anyone expected, so not perfect, but strong earnings nonetheless. Microsoft had their earnings and pretty much met expectations. They kind of beat them, but only by a tiny margin. Really nothing major there. They beat their earnings per share estimates by 3 cents, for instance, which is a very small margin. Microsoft stock actually fell on this news at first, down by as much as 2% after hours, but then the markets decided that they actually liked this news, so it rallied up almost 7%, only to then fall another 2%. Completely irrational movements, but it was all after hours trading, so volatility is supposed to be a little bit larger. Really, the market just had no idea how to price this report. Microsoft has now settled pretty much exactly where it started trading yesterday though. Google, of course, reported their earnings, but they didn't do so well. They were, of course, still growing at about 20% for the most part, which is really strong for most companies, but they did miss their expectations slightly. They missed their earnings by about $100 million. Not a huge miss, but a miss nonetheless. YouTube, on the other hand, actually did quite poorly and seemed to be the main thing that everyone was looking at for this report. They missed their revenue targets by about 10%. They took a major hit for their high growth part of their business, and that is bad for the business, and investors didn't like it at all. Google's cloud business actually did really quite well and beat earnings expectations. Investors, though, still weren't happy, focusing instead on the negative news surrounding YouTube. After hours trading saw Google's share price fall by 7% before settling at around 3% lower than when the market closed. Over the last month now, Google has fallen 16% in price, which is a major hit. The company now has a PE of 21, which for a company growing that fast and that efficiently is actually a really reasonable price point. But from my point of view, asset prices are at the moment not determined by the intrinsics of the business that they're supposed to lie on, but by the monetary environment, and that environment is getting worse. So I'm not going to buy Google just yet, but I will when I think the stock has bottomed. It's just such an incredible business and at such a reasonable price. Finally then, we have to talk about Tesla to finish us off. Now, they didn't post any reports, their earnings or their deliveries, but the share price still fell by 12% yesterday alone. It's now down by over $275 billion since earlier this month, or a 23% fall. Now, why is Tesla falling? Well, partly on these general tech stock declines, the same reason that the markets is falling because the monetary environment is just looking poorer, but also partly because of Elon's Twitter antics. Now, it's pretty common knowledge at this point, but to buy Twitter, Elon is taking out margin on his Tesla shares. There is now a chance that if Tesla falls enough, he will get margin called and he will be forced to sell Tesla shares, which would then hurt the share price even more. In response to this, the market is now worried that he might get margin called, so Tesla is now a more risky stock to own, so people are selling some positions and the stock price is falling. There's also a fair bit of fear going around right now that say that Elon might pay less attention to Tesla and that the company might suffer as a result. Now, the idea here is pretty simple. He owns or he runs a bunch of companies, the boring companies, SpaceX, Tesla, and now we can add Twitter to that growing list. There's a decent chance his attention does get more and more divided, and maybe Tesla suffers as a result of that. Is a 12 or almost 13% decline in one day on this non-news justified though? Well, not really, but in my opinion, the share price of Tesla being that high above $1,100 in the first place was never justified either. So this really is just Tesla being Tesla. It's always been super volatile. Now, regarding the tensions with Russia and the West, things are not really getting any better. Yesterday, Russia announced that it was cutting off Poland and Bulgaria from gas supplies to those countries because they've refused to pay for their gas in rubles. Funnily enough, Russia isn't cutting off the 15 or 20 other European countries refusing to pay for gas in rubles, indicating that they are aware that they still need that income just as much as Europe needs that gas. Gas prices, of course, surged on this news, which is awful for inflation and business across Europe. Poland says they will just weather the storm, though. It's about more than money to them. It's about the existence of Poland and Eastern Europe as individual countries. Energy rationing is probably coming for these countries too. In short, though, it's just another case of relations getting even worse that will impact markets and shake investors. The next problem regarding Russia is that we might see the war in Ukraine expand to Transnistria, the Russian-backed separatist part of Moldova that has a few thousand Russian troops in it. There was a reported explosion there overnight. Russia is claiming that Ukraine bombed them. Ukraine are claiming that it's a false flag attack. To be perfectly honest, Ukraine is not looking to expand the number of fronts that they're fighting this war on. So in my opinion, it's very unlikely that they have attacked Transnistria. A false flag is far more likely in this case. Either way, right now there's a chance that the war expands. It's a little bit unlikely in my opinion, but it is possible nonetheless. If they bring this new country into it, that would be bad for business, bad for markets, and scary for investors. Now, if you enjoyed this video, then make sure to like, comment, and subscribe to bless the YouTube algorithm. If you want more content like this, then check out our Patreon and join our community of investors. You get access to our Discord, loads of exclusive content like insight into my portfolio, and buy and sell alerts for all my own investments. There's a link in the description to masterworks.io, a site that can help you protect your portfolio against inflation through fractional shares of art from world-famous artists like Banksy. Art has historically proven to be uncorrelated to the markets, so it's a really valuable resource with the markets on the brink. It's completely free to sign up, so make sure to check it out. There's also a link in the description to BlockFi, which will give you up to $250 in free Bitcoin when you use it. You can also get over 7% interest on stablecoins to protect your hard-earned cash from being eaten away by inflation. Thank you all for watching. Stay stoic. Till next time.